Welcome back to the Short Put Masterclass. My name is Stephen Cox and I'm the CEO of Share Navigator and I'm a full-time options and futures trader. So far, we've covered the short put trade mechanics. We've established how you get your break-even point, your maximum loss, your maximum profit. And we've used SPY as an example and why we believe you can get a statistical edge by using the short put strategy with the S&P 500 ETF SPY. We've also covered four of the option Greeks, Delta, Theta, Gamma, and Vega, and really highlighted why selling put options when implied volatility is high is very, very important. Today, we're going to focus in on actually placing the trade for real, and we're going to give you some guidelines as to how to plan for your trade before you even put it on first. Then we walk you through step by step how you're going to use an online broker to look at your profit and loss tables. And then finally, in the final episode, once we've placed the trade, we're going to show you how we go and manage that trade on an ongoing basis. So there's very important points that we make during the next two episodes. So please rewatch these over and over again if you're going to apply the short put strategy for real in your account. Okay, so the first step, and probably the most important step, is in your trade planning. And step one is to decide what type of trade this is going to be. So remember, there's two types of ways of looking at the short put strategy. You can look at it from the cash secured put point of view or the return based strategy. So the cash secured point of view would be that if you got assigned the stock at expiry, you wouldn't have an issue with it. And you have the cash there in your account to pay for the assignment of the shares. So with SPY, for example, if we've sold a $640 put option, technically we would need to have $64,000 in our account to take that assignment. Now, you don't actually need to have that. We're going to talk about that with margin. So is this a stock you really want to own at that strike price? And if it is, then you simply place your short put and you walk away. There's no trade management thereafter. If you get assigned, you're happy enough. But on the flip side, the return-based strategy, this is where you've absolutely no intention of taking assignment of the stock. And this is important then when you check the margin. We're going to show you how later on in this episode how to do that. But our rule of thumb here is that your margin should be no more than 50% of the value of your account for all positions. So remember, if you have other positions in your account, they might have a margin position on them as well. So we're going to show you how you check that before you even place the trade. And remember, we're using a 30K account as an example with this short put trade on SPY. And the margin for that is about $9,000. Our total margin is just over 18. So we're thereabouts where we're saying we wouldn't place any more trades thereafter. So we would recommend for return-based strategies of sticking with with ETFs like SPY and avoid stocks. And the reason for that is, whilst applying this strategy on individual stocks will probably give you more premium, they tend to be more volatile. Think about the exchange traded funds SPY. It's a basket of stocks. So worst case scenario, you take the assignment, you're not going to lose any sleep. Where if, for example, you've applied a short put strategy to a stock that you don't want to own, you're just looking to generate the premium, an earnings report, they can come out with a bad announcement overnight and things can change very, very rapidly. So we wouldn't recommend applying this strategy from a return-based point of view on individual equities. Stick with ETFs like SPY, for example. And then finally, if your account is extremely small, so for example, if your account is less than 10 grand, then doing a short put on SPY is not for you. It's your margin will be too much. So, but the great news is you can still place a high probability trade and just use the sister strategy, which is called the bull put spread. And we have another course on that to show you how to do it. So it's just a variation of the short put with a bit of protection in there. You don't make as much money, but your risk is absolutely limited and you can decide how much risk you want to place. So for smaller accounts looking for high probability trades like the short put strategy, the great news is you can do it, but just do it through a bull put spread. From here on in, with our SPY example, we're going to assume we're using a return-based strategy for the rest of this example. Okay, step two in the trade planning is to confirm our outlook for SPY. Are we extremely bullish on SPY or just mildly bullish? And the reason I ask you that is because if you think something's going to go up, maybe the short put strategy is not for you. Maybe buying the stock or long calls is a better strategy to apply. You will generate more profit if you're correct. But a mildly bullish strategy is where you're kind of not certain. You just believe it's not going to fall below a certain level, well, then the short put strategy is definitely the way to go. And just a reminder, this is a return-based strategy. We're looking just to generate a return with a high probability of success. So that's why we're applying this short put strategy. And then look at your IV rank. Now, there's no hard and fast rules on this. Best applied if IV rank is above 50. Because when you have a low IV rank, it means the premium on offer aren't as good as when the IV rank is high. It just means you're getting paid more for taking the risk. Now, with something like the S&P 500, which is on a bull run, sometimes it's very difficult to apply. IV rank can be low for quite some time. So this is a trade-off you've got to make as well. So here's an example in your online brokerage account. You can see here the options quote screen, and we have the 52-week IV rank is 13. Now that's very low. Normally we wouldn't place this trade. We would wait for the IV rank to be higher, but because we're trying to demonstrate to you what a short put trade looks like, we're just going to go ahead and place the trade. We would prefer that was closer to 50. And recently we actually did a trade when IV rank spiked up to 50 and we generated twice the premium we're about to get. But just again, this is an example we're going to show you. So step 3 is pick an expiration 30 to 60 days out. We told you that because of time decay. And then when you're picking your strikes, again, no hard and fast rules, but try and choose deltas of circa minus 0.15 to minus 0. So we're back to our quote screen again. You can see we're going out 49 days. We've picked the December 19th expiry, and the expiries are usually at the top of your window. And then we're looking at the delta. We can see the 640 has got minus 0.167. If you looked at the 644, it'd be minus 0.183. So we're going to get paid more for the 644, but because we're looking for a really high probability trade, we're going to go with the 640 strike. And that delta tells us we're going to have well over an 80% chance of winning in this trade. So we're going to pick that strike, the 640 strike. So step 4 is calculating your risk and reward. What's your max profit break even, probability of profit, and your maximum risk. This is all going to be done for you in the next step through your online broker. And we're going to show you how. But we just wanted to highlight, if you're not happy with your maximum risk, to remind you again, switch to the bull put spread strategy. Okay, so let's place the trade. We simply click on the bid price. And this will bring you to an order window similar to the above. Let's break each section of this down. So at the top of the window, it's telling you sell 1 December 19, 640 put. It's telling you your break even there, 635.21. On the right hand side, it's saying order minus 4.72. And you see it says credit. That means it's cash going to go into your account straight away. Underneath that, you have the bid ask spread. And then it's reminding you of the trade again at the bottom of that window. In the middle window, it's telling you your maximum loss. You can see it's 63,115. Now, that would assume the S&P 500 went to zero, which is highly improbable. But you still know, theoretically, when you invest in any stock, if it goes to zero, you can lose everything. The break-even price, 635.21, and your maximum return is 476. So again, if you don't like that maximum loss position, switch to a bull put spread. But look at your probability of profit in this trade. It's 92%. It's not a guarantee. It means you have an 8% chance of losing, but you do have a 92% chance of being profitable. And I would remind you of the stats that we have on the S&P 500 and why we like this return-based strategy on that. 90% of the time, the S&P 500 goes up or down by 5% in a given month. And with this trade, we've allowed it to fall nearly 8% before we lose money. So statistically, that's why we have a probability of profit of over 92%. And in the bottom of the window, you can see it has your profit and loss tables, and it automatically diverts to the expiry date. But you can change that to a different last trade date. And you can see that if the share price goes up or down by 5%, we still make our max credit, the beauty of this strategy. So if we're happy to place the trade, you click on the blue order button on the top right hand corner, and this is the window you will see. In the middle of that window, you can see the quantity defaults to 1 if you're doing one contract, but you can change that to 2. Then you have a limit price, and you can dictate the price that you are willing to receive and leave it as a day order in this situation. So for short puts, we recommend leaving it as a day order. We're going to haggle and choose 470. So we clicked on the preview button, and what I want to highlight, it tells you the trade again, but look at the margin impact. It goes initial margin 9421, and then an additional margin for this new position of 9758 for a total margin of 19,000. So on the top, you can see we got filled in our trade, and we actually took in $480, even though we only asked for 470. So you'll always get filled at the best available price, and underneath you'll see what your trade position looks like. In the next episode now, we're going to talk about how you manage the trade. That's really important and probably the most important episode.